Why does
Right. Jumping the gun, but will work.
Tonight's recording is recorded on January 15th, 2024. We're going to be covering supply and demand. This will be a two-part series, approximately 1 hour for each. Take it, Ripper.
Okay. Hello, everybody. This is our fourth lesson on the chart tool, and we're going to specifically be covering supply and demand bands. Now, there it goes. A little sluggish. So if you really want to get into the theoretical discussion as to, what supply and demand bands are, and all of the theory about how we derive them and how we find them in that, I'm going to send you to a presentation that's been recorded. It's up on our YouTube site. You can see the link to that I have posted here. There we go. Down here, supply and demand making objective part 1. Because we have so much to cover on the chart tool and the settings that we can't afford to spend 2+ hours, just going over all of the theory behind this. So we're going to do a very brief recap of what's there, and then start looking at the settings and getting into the settings, because there's a lot of stuff there. And even then, we're not going to be able to cover all the settings in the time we have. So we're going to be looking at the critical settings and the settings that are used most frequently. The settings we're not going to get into are pretty much the graphics related stuff. Those are the same as what we've seen in the prior lessons, just being applied to different lines. That's what it comes down to, or a different graphics object, a different label. But it's all the usual suspects, things like color and transparency and thickness and that kind of stuff. So if you've been through the other lessons, there's no point in going through that again. So we're going to go through the critical stuff. So what exactly is a supply band? What exactly is a demand band? Well, basically, a supply band is an area on the chart where we expect there to be a significant amount of supply. Now, what is supply? Supply is basically unfilled sell orders. So in that area of the chart, we have reason to believe that there's a lot of unfilled sell orders. And there's enough there that when price comes back, we're going to get a reaction from price and in the way it moves. You flip that over, you get a demand band. And that's an area on the chart where we expect there to be a significant amount of demand. And what's demand? It's unfilled buy orders. Now, supply and demand bands are associated with bases. We're going to do a review on bases because they play such a major role here. But if you want more information on bases and how the tool finds bases and all of that, you can refer back to, I believe it was our first training session. And again, for an in-depth discussion of the theory behind bases and supply or demand bands, again, you can go back to the video, Supply and Demand Making It Objective, Part 1. Now, a base which breaks upwards is a potential demand band. And a base which breaks downward is a potential supply band. And we'll see that in a moment. Let's do a quick review of our terms and definitions here so that we're all on the same page. And again, if you were in the earlier training, this should all be familiar to you. Or if you've seen the Making It Objective presentation, this is all in there as well. So I'm going to go over this pretty quickly. Now, the first thing of interest is what we call a basing candle. And this is simply a candle where one or more candles that follow it close between its high and low. So they close within the range of the basing candle. Now, this means that there has to be an area of supply above the basing candle and an area of demand below it that's trapping price, forcing the candles that follow the basing candle to close within the range of the basing candle. So the candles that follow the basing candle, you can think of them as being trapped between that area of supply above and that area of demand below. You could also say that you have a relative balance here if you wish. And this is a condition that's known as basing. Now, the candles that follow the basing candle, they're just referred to as a base candle. And their major criteria is that they close in the of the basing candle. And together with the basing candle, they form the base that has price trapped. Now, the base ends with the first candle that closes outside of the range of the basing candle. And that candle is known as the leg out. Now, the leg in we didn't talk about before, but typically the leg in is the candle before the basing candle. And if you're in a downtrend, we would like it to be a candle that closes below the previous candle's low. And if you're in an uptrend, we would like it to be, again, a candle which closes above the previous candle's high. And we want this to be the candle immediately before our base. However, these days, the definition of a leg in has changed somewhat, and the actual basing candle that starts the base is often used as a leg in as well. Now, we have these two terms here. Again, these were in our prior training. We have the base high and the base low. And the base high refers to the supply that was left behind when you have a base that broke downwards. If you remember, we have supply above and demand below the base. And when price breaks out of the base to the downside, the demand, which had been propping up price and trapping it within the range of the basing candle, trapping it in the base, has been eliminated. But the supply that was holding price down, keeping it trapped, is still there and is left behind. And that is known as the base high. And the tool will draw a line to mark the base high on the chart for you. The base low is the area of demand that remains when price breaks out of the base to the upside. When it breaks out to the upside, the supply, which had been holding price down and keeping it in the base, is gone. But the demand, which had been propping price up and keeping it in the base, is still there and is left behind. And that demand is known as the base low. And again, the tool will draw a line there for you to mark that. So picture's worth 1,000 words. So let's go see what this looks like graphically. So here we have a sample base. The base has not been broken yet. And we can see we have our basing candle that starts the base. And we have supply above that basing candle, and we have demand below the basing candle. And then the candles that follow the basing candle all close between the high and the low of the basing candle. We can see here, price made an attempt to break out of the base to the upside, but that supply squashed it. We had price make an attempt to break out of the base to the downside, and again, the demand rebuffed that attempt, pushed things back up. So this is what traps price in the range of the basing candle forming the base. Now, the tool will mark the basing candle with a yellow tick mark if you have that enabled. And by default, the tool will mark basing candles that are not nested inside of another active base. If you tell it to, the tool will also mark all basing candles, even if they are nested. However, that's generally not terribly useful. So it's good for learning what a basing candle is, but for actual trading, we don't want the nested basing candles. You know, and we'll talk a little bit more about that later. Now, since this base is not broken, you can see at the top here, we get a red dashed line. This is the default. Of course, you can change that. But this is the default for marking a base high. And the base high is normally drawn at the top of the basing candle. You can optionally have it drawn at the high of the body of the base if you wish. But the default is to draw it in the traditional place at the top of the basing candle. On the bottom, we have the dashed green line. This is the base low line. And again, this is drawn at the low of the basing candle, and it represents the demand. Now, since this has both of these, both the base high and the base low, this is the current base in control. This is the current base that has price trapped. And this is the most recent basing candle. So it's the basing candle in control. When price breaks out of here, one of these lines is going to go away, depending upon which side price breaks out and whether supply or demand gets eliminated. Now, let's look at a possible supply band. Here we have a base. Again, we had supply and demand above and below, trapping price within the base, but now price is broken out to the downside. So that demand has been eliminated. And we have supply above that's left behind. Similarly, the tool is still going to mark this with the base high line here. We have not yet marked this as a supplier demand band. And there's a reason for that. We'll get into that in a moment. Here we have a possible demand band. And we can see here we have demand that's left after the base broke to the upside and took out supply. And again, this is a base low, so the tool is going to mark that if we have, you know, the marking for base highs and lows turned on. But I'm saying these are possible, all right? What is it that would change this from being a possible demand band, or the previous one, a possible supply band, into an actual supply or demand band? Well, it's something that's often called odds enhancers. And these are basically characteristics of the candles or the pattern of candles that give us a warm fuzzy, let's call it, that there may actually be a significant number of unfilled orders at that location. Now, just because we don't find the odds enhancers doesn't mean that there's not, unfilled orders associated with, the band we're looking at, or not the band, but the base, I should say, that we're looking at. If we don't find odds enhancers, it just means that we don't have any way of judging how many unfilled orders may be there. And we're not going to go and take, a broken base and turn it into a supplier demand band without some kind of indication that there's a significant number of orders there. So the tool will still mark that location with a base high or a base low, if you have that enabled. But if we can't judge, or have no basis for judging how many unfilled orders may be there, we're not going to be able to mark it as a supplier demand band. So what we're going to do is we're going to examine the candles in the base, plus the leg in and the leg out. And we're going to look for certain characteristics that are correlated with there being a significant number of unfilled orders. And if we find the characteristics we're looking for, then we'll be able to, I guess you could say, promote it from being, a broken base and merely a base high or a base low into an actual supplier demand band. Now, since we're only looking at the base plus the leg in and leg out candles, there's really only 4 patterns that you can make. And these are the 4 patterns that, we've all come to know and love, I guess you could say. The 4 patterns that are associated with the supply and demand trading style. And that's the rally base drop, which we see here. We have the drop base rally, the drop base drop, and the rally base rally. So those are really patterns that we're going to be looking at. And again, we're going to be looking at the leg in, the leg out, and the base to try to come up with some kind of estimate. And it's not going to be a precise estimate. It's just going to be a ballpark estimate of how many unfilled orders may be at that location. So what are some of the things we're going to look at? Well, we're going to be looking at the leg in and leg out carefully. We're going to be looking at the size of the leg in and the leg out candles. We're going to look at how much of those candles reside in the body versus the wicks. We're going to look at the candle position relative to the base. We're going to look at the actual candle color and when there, or if there was an actual gap. So did we have a gap into the base? Did we have a gap out of the base? And in the case of the leg in, we're also going to look at the basing candle itself to see if we can use that as the leg in if the leg in we find doesn't qualify. So if the candle before our base, which would normally be the leg in, does not meet our criteria, then we're going to look at using the basing candle and see if the basing candle can essentially do double duty. So one of the first things we're going to look at is the strength of the leg in or the leg out. So what constitutes a significant leg in or leg out? And you can see here on the left, we actually have the settings in the tool that are associated with this. Well, to try to figure out whether our leg in or leg out is significant, we're going to look at the ATR. The ATR provides us a measure for, what price movement is taking place from one candle to the next. So we can use the ATR as a context for evaluating our leg in and leg out candles. And we can use the ATR to determine what an acceptable leg in or leg out candle may be. So our settings here for the leg in strength or the leg out strength, these are going to be specified as a multiple of the ATR. And our default for the leg out strength is we're looking for a leg out to be at least 1.25 times the ATR. And that is what we would consider to be a significant leg out. So that shows that there was an abrupt move out of our base, and that was at least 25% greater than the average move that we've been seeing at that point in time. So that is what we use by default for the minimum acceptable leg out strength. The leg in strength, our value for that is a lot less. We actually only require 3/4 of the ATR for the leg in strength. And that came out of back testing. That's where that value came from. We found that the leg in strength was not as important as the leg out strength. But that may be something that you want to check for the markets that you trade. And markets do change over time. So you have the ability to set that, and you can back test to determine what works the best for your particular market. Now, let's talk about gap handling. How do we want to take into account gaps? Well, the way that we're actually doing that by default, and this is the setting that lets you change this, but by default, we're going to take a gap and we're going to combine the gap with the leg in or the leg out candle, depending on whether it's a gap in or a gap out. And we're going to make it become part of the body of that candle. Now, why exactly are we doing that? Well, let's say we have the case right here on the left. We can make it even more severe if you wanted to and make that a doji instead of a little green candle. But we had a significant move up there. And for a lot of the things we're going to be looking at when we're looking at the properties of the leg out candle, this little green candle, or again, if we made it a doji, just for the sake of argument, that's going to fail a lot of the other tests that we're going to look at and we're going to talk about. Yet clearly we had a major move there. So if we take the gap out and we combine it with our leg out candle, and it becomes part of the body of that candle, that's then going to transform that leg out candle and give it a much better chance of passing all of our tests. So this is why we have this enabled by default. If you go in and turn it off, then that little green candle is going to have to meet all the other tests by itself in our example. And that'll result in a lot less, supplier demand bands being found. Now let's look at some of the other leg out related settings. So we've already talked about the first one and how we are going to specify the minimum acceptable strength for our leg out candle as a multiple of the ATR. I'll say right now on all of these, I'm showing the settings for a drop-based rally. We have independent settings for each of the 4 patterns that we're looking for. And those settings are going to be adapted to that particular pattern. Most of the settings end up being the same, but there are some that you have to change a little bit. And the setting names for the other patterns are basically going to be the same here, just the first 3 letters are going to change the abbreviation for the pattern. So required leg out strength, that's a setting that's there for all of the 4 patterns that we look at. And here it's for the drop base rally, so it starts with DBR. If you go in and you look at the settings for the rally base rally, required leg out strength is there, but it starts with RBR instead of DBR. And for a rally base drop, it would be RBD instead of DBR. So the descriptions, I've written them up to be somewhat generic instead of specific for the DBR. And again, the reason is that these settings exist for all the patterns, not just for the DBR. But I can't go putting all the settings for all the patterns up on the screen, so I only put the ones up for the DBR, and our examples are going to be based on the drop base rally. But you should be able to easily extend that to the other patterns we look for.
Ripper,
So, yes.
In calculating the ATR, you do not include the leg out. You stop 1 bar before the ATR and go back maybe 14, maybe 10. Is that true?
We'll get to that.
Okay.
The ATR settings we address later. So we'll get to that. Okay, don't forget.
All right.
Okay. Okay, so the first, whoops, I hate it when it does that. Okay, so the first setting here is the leg out strength. And again, we talked about that earlier and how that's going to be a multiple of the ATR. The next one is how much of the body of the candle should be, or excuse me, how much of the candle, the leg out candle, should be in the body versus the wicks. And so this is going to be a percentage. And again, you're specifying how much of that leg out candle must be in the body, not the wicks. And we'll see some examples later where that comes into play. The next setting, this basically, for a DBR, it says that the leg out candle must be green if you set this setting to true, which is the default. Now, some people don't care as to what color the leg out candle is, but there are times and reasons why you certainly may want to consider the color, and we'll see an example of that later. But if the leg out candle is not green, then we will not turn it into a demand band in this case, since it is a DBR. The last one here, this is how much of the leg out candle is allowed to be below the base, below the body of the base. And again, that can be significant as well. So this candle this setting helps to control the orientation of the leg out candle to the base itself. And by default, we don't allow more than 20% of the leg out candle to be below the body of the base. Again, that's something that you may want to back test for your particular market to see how well that works. But so far, that has proven to be a reasonable value for quite a few markets. Now for the leg in, we have very similar settings to what we had for the leg out. We have the required leg in strength, which is specified as a multiple of the ATR. The next setting, again, is how much of that leg in candle has to be in the body versus the wicks. And again, we'll see some examples later of why that could be significant. After that, again, should the color of the leg in candle match what's expected for the pattern is what it comes down to. Since this is for a drop-based rally, drop candles are normally red. This setting is true by default, so we expect a red candle. If we don't get a red candle, we're not going to accept that base and turn it into a demand band. Next, there's the question of how much of the leg in candle is allowed to go below the base. And again, we'll see an example of why that can be significant later. You know, having a little bit of the leg in candle below the base is not such a big deal, but if you have too much, then the odds of that band, if you were to turn it into a band, the odds of that band failing go up significantly. Now, the next two settings here, again, we're talking about a drop base rally here. So the leg in candle should start somewhere above the base, ideally. And these two settings basically set a minimum for where that leg in candle has to start relative to the base. So again, we are orienting the leg in candle with respect to the base. And if our leg in candle does not meet that orientation that we're after, again, we're not going to turn it into a band. And one of these settings indicates that the high of the leg in has to be above the high of the base. The other says it has to be above the high of the basing candle. Now, the next setting, the leg in candle mode, this determines whether or not the basing candle can be used as a leg in. You can go in and tell the tool that the leg in must always be the candle in front of the basing candle, which starts the base. Or you can tell the tool that it's always going to try to use the basing candle as the leg in. Or you can tell the tool to try the candle before the base. And if that doesn't work, then try the basing candle to see if you can get one of them to work. The default is to try both. So the tool will come in and it will initially look at the candle in front of the base, the one before the basing candle, to see if that can qualify as a leg in. And if it does, it takes it and runs with it. If it can't, it then tries to see if the basing candle can do double duty. If it can meet the requirements to be a leg in as well as the requirements to be a basing candle. And if it can, then we're off and running again. Otherwise, it will reject the base.
Question.
Yes.
If you have in the formation of a demand, you have the lagging candle to gap down maybe 1 point in the S&P and then move up and close it. And then it bases maybe 3 bars and then has a leg out. So the lagging candle there would be green. So that is not going to be considered demand.
Okay, so, well, for a drop base rally, okay, your leg in is not a drop candle. It's the wrong color to be a drop candle. So you would break that rule unless you have that rule turned off. So if you set DBR red leg in required to false, then you can turn off that rule. Then the next question is, where is that position relative to the base? And does it extend below the base? If it extends below the base, then the question is, how much does it extend below the base? And if too much of it is below the base, then that can get it rejected as well. So it's going to depend on, exactly what it looks like and what settings you're using, what rules you've turned on and off, and what rules you've modified as to whether that would be accepted or not. That makes sense?
Yeah, what setting is going to give us to catch all at least maybe 60%?
Well, I'm not sure what percentage is going to be captured by that, but one of the things you've got to consider when you're making rule changes is you have to consider what's often called the downstream effects.
Yes.
So for instance, if we go in and we change DBR red, leg in required. Okay, we may pick up a specific case we were looking at, and that case may work. However, how many other cases will now be accepted by the rule change, and how many of those will succeed and how many of those will fail? If more of those fail than succeed, the overall result of the rule change may be negative and impact our trading in a negative way. Even though, we picked up a few more winners. It's again, because with those winners came along a bunch of losers. So whenever you're making these changes, you got to look at the downstream effects to see what else is getting through because of the rule change, and how many of those new items getting through are winners and losers, and how much do they win by, how much do they lose by, so you can figure out what the net result of the change is. And that's where you get into back testing.
So that also means that with the default setting,
Yeah,
there's some kind of maybe back test that has been done to minimize the downstream effect.
more or less, yes. there was a bunch of tests that were done. We had the study group going for quite a while, and there were a lot of back tests done. And we didn't get to test everything as extensively as we would have liked. But based on, what we were able to do and what people's experience was, that's where we set the defaults to. Now, the problem you get into, of course, is that the defaults are, the first thing that's going to be used on every market. So we had to make some compromises. It's unlikely that, the defaults are the optimum settings for any given market, but they're settings that worked well enough. I guess you could say they were good enough on quite a few markets. And most of us actually use the default settings for most items. There's very few changes I make. I only change graphic settings to make it look better on the screen. And I changed the band creation method, which we'll talk about in a little bit. But that's really, about it. Now, if you have the time and you can put in the effort and do the back testing, you might be able to come up with something better than the defaults for the particular market and, times that you trade. In which case, then you can go and save your optimal settings using another feature of the tool, which we're going to talk about tomorrow, called the OSF subsystem, so that the tool will automatically use your special settings whenever you go to that particular market. But ideally, you're going to want to backtest. It's like if we look at the settings that are typically given out for the RSI, there's the 60-40 rule, which has been around for quite a while. Is the 60-40 rule ideal? Well, we've seen on some markets that no, it's not. I think it was ES. We saw that. I guess we did this back in 2020 or 2021. We saw that 65 and 40 work better than 60 and 40. And markets change over time too. With the way things are now, I can't say that that's still a true statement. We'd have to backtest and see, because markets do change over time. But 60 and 40 was providing a benefit. It's just that 65 and 40 produced a bigger benefit for the market conditions that existed when we ran the test and for that point in time. So you're going to have to adapt as market conditions change. That's just the nature of the beast. And that's got, nothing to do with the tool. That's just the way markets are.
All right, thank you.
Okay, you're welcome. Okay, so the last setting here, we talked about the setting before, which determines whether or not you can use the basing candle as a leg in. And then the next setting, the leg in basing candle mode, determines when the basing candle is counted as part of the base and when it's not. And the reason for this is that we have a setting later on we're going to talk about which allows you to place a limit on the number of candles that may appear in the base of a supply or demand band. And so allowing the basing candle to count as one of the candles in the base or not can make a difference in whether, you know, a base gets turned into a supply band or a demand band. By default, if the basing candle is being used as the leg in, the tool will not count that towards the limit on the number of candles in the base. But you have the ability to change that. You can tell the tool to always count it, or you can tell the tool to never count it, or you can leave it at the default, in which case he only counts it when it's not being used as the leg in. In fact, here's a setting that I was just referring to earlier. This setting again restricts the number of candles that may appear in the base of a supply or demand band. And the default there is 6. So you're only allowed 6 candles. So if the basing candle counts or not can make a difference. Now, when we look at the candles in the base, we can place certain restrictions on them so that we don't have, you know, any unusual situations. For instance, if we have a candle in the middle of the base that's got a huge wick, is that really a good base? You know, I don't know. Some people will still use that, other people will not. So you have the ability to place restrictions on the strength of candles in the base, how big those candles can be. And again, that's specified in the usual way, which is as a multiple of the ATR. You can also place a limit on how much of the candle can be in the body versus the wicks. Another method for finding supply and demand bands is something called the boring exciting technique. And in that particular method, in your base, you want what's called boring candles. And so you don't want big candles. And the candles that are there, you would prefer to have more of the candle in the wicks than in the body. So this setting here, the max base candle body percentage, allows you to place a limit on how much of a candle in the body of the base can be in the candle body versus the wicks. Now, if you are using that and you get a very small candle, that candle could fail that test. And this is where the next setting comes in, the auto accept strength, which says basically if a candle's really small, we're going to take it anyway as an acceptable candle to be in the body, you know, in the body of the base, even if it violates, you know, some of the other rules. Now, the next setting, the use BCIC only. We talked earlier about how basing candles can be nested. And by default, we allow the tool to use nested basing candles when looking for supply and demand bands. If you want to change that behavior, at least for the drop base rally here, again, you can do this on a pattern by pattern basis. you can set this setting to true. And then the tool will not use nested basing candles. If you do that, typically you find a lot less supply and demand bands. And back testing wise, at least at the time we did the back testing, we found that there was an edge to using the nested basing candles because of all the other things that we look at when finding a supply and demand band. But again, for your trading style and for what you're doing, this may be something you want to look at. Now, the next two settings allow you to modify our rule for basing candles. Normally, we would have a basing candle. The candles that follow it have to close between the high and the low of the basing candle. But with the next two settings, you can go further than that. And if you put both of those settings on, then the entire candle that follows the basing candle must lie between the high and low of the basing candle. So if you turn on the first one, the strict base high criteria, not only do the candles in the base have to close between the high and the low of the basing candle, but their highs must also be less than the high of the basing candle. And the second rule, the strict base low criteria, if that's turned on, then the low of the candles in the base must be above the low of the basing candle. All right, so let's look at some of these situations and let's look at the settings that are involved in controlling that situation. So if we're looking at a case where we have a drop-based rally, and again, all the examples are going to be drop-based rally, but you can apply the same principles to the other patterns. But if you have a case where your leg out is more wick than body, what most likely happened? Well, price broke out of the base clearly, but then it immediately ran into opposition. And that opposition was pretty strong because it was able to push the leg out candle or the close of the leg out candle back towards the base. So if this move continues, and our example here, it will continue to the upside, we have to ask ourselves, how much of the demand associated with this base was burned up by that initial attempt, to break out and begin moving up? How much is still left? Because we made that initial move out, price got pushed all the way back. And now we're continuing on upwards, fighting our way up. We would prefer to see the second case on the right, where price broke out and made a nice significant move. And it didn't have to go back near the base to get more demand to continue moving upwards. Now, the two settings I have listed on the left can help us ignore the first case or bases of the first type and not turn those into demand bands and accept bases like the second one, which is the more desirable. And the first one, again, is we're going to require that the leg out have a certain amount of the candle in the body as opposed to the wicks. And the second one is very similar to the first one. And here you're specifying the maximum size that the wick on top of the candle could be. So they're giving you two different ways to accomplish the same thing. And again, what you're trying to accomplish here is avoiding the first situation on the left with the less desirable leg out, and you want the situation on the right. Now, in this case here, we have the leg out actually starting below the base. What exactly is that telling us? Where is the demand really located here in this case? Now, we would like to have the demand associated with the base, because that's what we use as the basis for drawing our supplier demand band. You know, in this case, it would be a demand band, but in general, we want the unfilled orders associated with the base. Yet the fact that the leg out was able to get so far below the base raises the question of where is the bulk of the unfilled orders really located? It's clearly not located with the base, or the leg out would not have been able to get so far below it. Now, in our preferred case on the right, we do go a little bit below the base, but not much. And there is noise in the price signal, especially as you go down in the interval. So it's not going to be uncommon to run into cases where, you know, our leg out is a little bit below the low of the base in our example here for a drop base rally. But as long as it's not excessive, like in the case on the left, that's acceptable. And we can compensate by moving our distal line for any demand band we draw from that. Effectively, then what we're doing is we're expanding the base to include, you know, the low of the leg out. So again, to limit the cases where the leg out is starting too far below the base, you can use the setting here, allow leg out below base, to specify how much of the leg out candle is allowed to be below the low of the base. The default at the moment is 20%, which is a bit generous. But again, you may want to back test on your particular market to see how often, you know, does this case on the left occur? And then how often does it fail? So that's something you can actually use the back testing features built into the tool to do. We'll be talking about those in another lesson, I believe, on Friday.
Our first hour is up. Stopping the recording, and then we'll start just again.